Listen to me very carefully because what I'm about to tell you could save your financial life. If you're holding significant amounts of cash right now, waiting for the perfect time to invest or trying to time the market bottom, you are making one of the most expensive mistakes in modern investing history. Cash is not just dead money anymore. It's dying money that's being systematically destroyed by forces beyond your control. The economic environment we're facing in 2026 is unlike anything we've experienced in our lifetimes. We're trapped between the rock of persistent inflation that's eroding purchasing power and the hard place of market volatility that's terrifying investors into paralysis. While most people are frozen with indecision, smart money is quietly positioning itself in specific assets that will not just survive the chaos ahead, but actually profit from it. I'm going to share with you the exact 3 ETFs that I'm using to position my portfolio for what's coming. These aren't speculative plays or get-rich-quick schemes. These are strategic defensive positions designed to preserve and grow wealth during the most challenging economic period most of us will ever face. But first, you need to understand why holding cash right now is financial suicide, even if it feels like the safe thing to do. The illusion of safety that cash provides is exactly that, an illusion. While your bank account balance stays the same, your purchasing power is being destroyed every single day by inflation that's running much higher than the government wants to admit. If you're serious about protecting your wealth and positioning yourself to not just survive, but thrive during the market chaos that's coming, you need to subscribe to this channel right now and pay attention to every word I'm about to say, because the strategies I'm going to reveal could be the difference between financial devastation and financial independence. Let me start by explaining exactly why cash has become the most dangerous asset class you can hold in 2026. The Federal Reserve has created an impossible situation where they must choose between fighting inflation and supporting asset prices. Either choice leads to the destruction of cash purchasing power, but through different mechanisms that most people don't understand. If the Fed continues raising interest rates to fight inflation, they'll crash asset prices and trigger a recession that forces them to eventually cut rates and print money to stimulate recovery. If they stop raising rates or start cutting them prematurely, they'll reignite inflation that directly destroys the value of cash and fixed income investments. Both scenarios end with cash holders getting destroyed. But the problem goes much deeper than just Federal Reserve policy. We're facing structural inflation driven by deglobalization, supply chain reshoring, demographic changes, and massive government spending that can't be controlled through monetary policy alone. This means that even if the Fed successfully brings down measured inflation temporarily, the underlying pressures for higher prices will persist for years. The result is an environment where cash earns 2 to 4% in savings accounts, while real inflation runs 6 to 10% annually. This creates a guaranteed loss of purchasing power that compounds over time, just like investment returns, but in reverse. Every year you hold significant cash positions, you lose 4 to 8% of your wealth automatically. Most people don't feel this wealth destruction because it happens gradually and the nominal value of their bank accounts doesn't decline. But the real value, what that money can actually buy in terms of goods and services, is evaporating steadily. By the time they realize what's happened, they've lost years or decades of purchasing power that can never be recovered. The second reason cash is dangerous is opportunity cost during what will likely be one of the most volatile and profitable investment periods in modern history. Market crashes and economic uncertainty create extraordinary buying opportunities for investors who are prepared and positioned correctly. But you can't take advantage of these opportunities if all your money is sitting in cash earning nothing. The biggest fortunes in history were built during periods of maximum uncertainty and market chaos. The Great Depression, the 1970s stagflation, the 2008 financial crisis, all of these periods created life-changing wealth for investors who had the courage and positioning to buy quality assets when everyone else was selling in panic. We're entering another one of these generational opportunity periods, but this time it will be longer and more complex than previous crises because we're dealing with multiple structural problems simultaneously rather than just cyclical economic weakness. The investors who position themselves correctly now will emerge from this period dramatically wealthier than they entered it. But positioning correctly doesn't mean taking huge risks or trying to time market bottoms perfectly. It means building defensive portfolios that can generate positive returns even during difficult economic conditions while being ready to take advantage of opportunities when they arise. This is where my 3 ETF strategy comes in. Instead of trying to pick individual stocks that might get crushed during market volatility, I'm using broadly diversified ETFs that provide exposure to the specific types of assets that tend to perform well during inflationary, uncertain economic environments. The beauty of using ETFs for this strategy is that you get professional management, instant diversification, and liquidity that individual stock picking can't provide. You're not betting on any single company or making complex investment decisions that require constant monitoring and adjustment. You're making 3 strategic bets on broad economic themes that should play out over the next several years. The first ETF in my strategy provides protection against inflation while generating steady income that can compound over time. This isn't just about preserving purchasing power, it's about actually growing wealth during periods when most assets are struggling. The key is finding assets that can raise their prices faster than the general inflation rate. The second ETF takes advantage of the massive infrastructure spending and technological transformation that governments are funding to address climate change, supply chain vulnerabilities, and national security concerns. These trends will continue regardless of short-term economic volatility because they're driven by political and strategic necessities rather than just economic considerations. The third ETF provides exposure to international markets and currencies that will likely outperform U.S. markets during the dollar devaluation that's inevitable given current fiscal and monetary policies. This geographic diversification provides protection against domestic policy mistakes while capturing growth in economies that are managing their finances more responsibly. Together, these 3 positions create a portfolio that should perform well whether we face continued inflation, economic recession, market volatility, or currency debasement. By diversifying across different types of assets and geographic regions, you're protected against most of the scenarios that could destroy wealth over the next few years. But the key insight is that doing nothing, holding cash, and waiting for clarity is actually the highest risk strategy of all. By the time the economic situation becomes clear and predictable, asset prices will already reflect that clarity, and the opportunity to position yourself advantageously will have passed. Now let me reveal the exact 3 ETFs that I'm using to protect and grow wealth during the chaos that's coming. These aren't random picks or popular funds that everyone's talking about. These are strategic positions based on fundamental analysis of which asset classes will outperform during the specific economic conditions we're facing. The first ETF is the Vanguard Real Estate Investment Trust ETF, ticker symbol VNQ. This fund provides exposure to real estate investment trusts that own income-producing properties across multiple sectors, including residential, commercial, industrial, and specialized real estate like data centers and cell phone towers. Here's why real estate exposure is crucial for surviving 2026. Real estate is one of the few asset classes that can maintain its value during inflationary periods because property owners can raise rents to keep pace with rising costs. Unlike bonds that pay fixed interest rates, real estate generates income that adjusts upward with inflation over time. But I'm not recommending direct real estate ownership, which requires large amounts of capital, creates liquidity constraints, and involves management headaches that most investors can't handle effectively. REITs provide all the benefits of real estate ownership with professional management, instant diversification, and complete liquidity. VNQ holds over 160 different REITs, which means you're getting exposure to thousands of individual properties across every major real estate sector and geographic region. This diversification eliminates the risk of any single property or market causing significant losses while ensuring you capture the broad benefits of real estate inflation protection. The fund currently yields approximately 4%, which provides steady income that exceeds what you can earn in savings accounts while offering the potential for both dividend growth and capital appreciation as property values adjust to inflationary pressures. This combination of current income and inflation protection makes VNQ an ideal core holding for uncertain economic times. But the real power of VNQ comes from its exposure to specialized real estate sectors that will benefit from long-term technological and demographic trends regardless of short-term economic volatility. Data centers that support cloud computing and artificial intelligence, cell phone towers that enable 5G networks, warehouses that facilitate e-commerce growth, all of these property types should see strong demand even during recessions. The second ETF in my strategy is the Invesco QQ Trust, ticker symbol QQQ, which tracks the NASDAQ 100 index of the largest non-financial companies in the NASDAQ stock market. This provides exposure to the technology and innovation companies that will drive economic growth regardless of current market conditions. I know what you're thinking. Technology stocks are volatile and risky during uncertain economic periods. That's absolutely true for individual technology companies, but it's not true for a diversified portfolio of the strongest, most profitable technology companies in the world. These companies have business models that generate enormous cash flows and competitive advantages that become stronger during economic stress. Companies like Apple, Microsoft, Amazon, Google, and Meta have platforms that become more valuable during economic uncertainty because consumers and businesses become more dependent on digital solutions when physical alternatives become expensive or unavailable. Economic stress accelerates digital transformation rather than slowing it down. QQQ provides exposure to approximately 100 of these dominant technology companies while eliminating the risk of picking individual winners and losers in a rapidly evolving sector. You're betting on technological progress and digital transformation continuing regardless of short-term economic volatility, which is one of the safest long-term bets you can make. The fund has generated exceptional returns over the past decade because technology companies have consistently grown their revenues and profits faster than the overall economy. Even during the 2008 financial crisis and the 2020 pandemic recession, the strongest technology companies emerged with larger market shares and higher profit margins than they had before the crises. But the real reason I'm buying QQQ for 2026 is that artificial intelligence and automation are creating a productivity revolution that will benefit technology companies regardless of broader economic conditions. Companies that can increase productivity through technology will maintain profit margins even during inflationary periods when other sectors struggle with rising costs. The third ETF is the most important for protecting against the biggest risk facing investors in 2026, which is US dollar devaluation and the relative outperformance of international markets. The Vanguard Total International Stock ETF, ticker symbol VTIX, provides exposure to developed and emerging market stocks outside the United States. Here's why international diversification is crucial right now. The United States faces fiscal and monetary challenges that other developed countries don't face to the same extent. Our debt to GDP ratio, our political dysfunction, our trade deficits, all of these factors put downward pressure on the dollar relative to other currencies. When the dollar weakens, international investments automatically become more valuable in dollar terms, even if their local currency values remain unchanged. This currency effect can add significant returns to international portfolios during periods of dollar weakness, which I expect throughout 2026 and beyond. But VTIX isn't just a currency hedge. It's also exposure to economies and markets that are likely to outperform U.S. markets during the coming period of economic stress. European companies often have stronger balance sheets and more conservative management than U.S. companies. Asian markets provide exposure to faster economic growth rates and younger demographics. The fund holds approximately 7,000 stocks across dozens of countries, providing true global diversification that eliminates the risk of any single country or region causing significant portfolio losses. You're betting on global economic growth and technological progress rather than just U.S. market performance. Emerging markets within VTIX provide additional upside potential because these economies are earlier in their development cycles and have more room for productivity growth. As automation and artificial intelligence spread globally, emerging market companies that adopt these technologies could see explosive growth in revenues and profits. Together, these three ETFs create a portfolio that should perform well under almost any economic scenario we might face over the next few years. If inflation continues, VNQ benefits from rising rents and property values. If technology adoption accelerates, QQQ benefits from growing revenues and market shares. If the dollar weakens or international markets outperform, VTIX provides currency and geographic diversification benefits. The allocation between these three funds depends on your risk tolerance and specific concerns about future economic conditions. A conservative allocation might be 40% VNQ, 30% QQQ, and 30% VTIAX. A more aggressive allocation might emphasize QQQ more heavily while reducing VNQ exposure. But the key insight is that any allocation across these three funds will likely outperform cash over the time periods we're discussing, while providing much better protection against the various economic risks we face. You're not trying to time markets perfectly or pick individual winners and losers. You're making broad strategic bets on asset classes and geographic regions that should benefit from long-term economic trends. The implementation strategy for building these positions is crucial because market volatility means that prices will fluctuate significantly over short periods. Dollar cost averaging into these positions over 3 to 6 months eliminates timing risk while ensuring you don't invest all your money at temporarily high prices. Set up automatic monthly investments that build your positions systematically, regardless of short-term price movements. This disciplined approach prevents emotional decision-making while ensuring you capture average prices over time rather than trying to predict optimal entry points that nobody can forecast accurately. The tax implications of this strategy are generally favorable because these ETFs are tax-efficient vehicles that minimize taxable distributions compared to actively managed mutual funds. You can implement this strategy in taxable accounts without creating excessive tax drag on your returns, though tax-advantaged accounts like IRAs provide additional benefits if you have available contribution room. But the most important aspect of this strategy is starting immediately rather than waiting for more clarity about economic conditions or market direction. The longer you wait while holding cash, the more purchasing power you lose to inflation and the more opportunity cost you incur from missing potential investment returns. Now let me give you the exact implementation strategy for building these positions while managing risk and maximizing your chances of success during the volatile period ahead. Because having the right investment strategy is worthless if you don't execute it correctly or if you panic and abandon it during temporary market turbulence. The biggest mistake most investors make when implementing new strategies is trying to deploy all their capital immediately because they're afraid of missing opportunities or because they want to get the process over with quickly. This all-or-nothing approach creates unnecessary timing risk and often leads to buying at temporarily inflated prices. My recommended approach is systematic position building over 4 to 6 months using dollar cost averaging with strategic adjustments based on market conditions. Start by determining your total target allocation to each ETF, then divide that amount by the number of months in your implementation timeline to calculate monthly purchase amounts. For example, if you have $100,000 to deploy and you're using a 6-month timeline with equal allocations across all 3 ETFs, you would invest approximately $5,500 per month, split roughly equally between VNQ, QQQ, and VTIX. This approach ensures you capture average prices over time rather than gambling on perfect timing. But here's where you can add intelligence to the mechanical dollar cost averaging approach. If any of the 3 ETFs decline significantly during your implementation period, say 10% or more below your initial purchase price, increase your allocation to that fund for the next month while reducing allocations to the others proportionally. This tactical adjustment allows you to take advantage of temporary market volatility without abandoning your strategic framework or trying to time markets perfectly. You're simply buying more of assets that have become cheaper while maintaining exposure to all 3 core positions. The allocation percentages between the 3 ETFs should reflect your personal risk tolerance and your assessment of which economic scenarios are most likely to unfold. Here are 3 different allocation models that work for different investor profiles and economic outlooks. Conservative allocation, 50% VNQ, 30% VTIX, 20% QQQ. This allocation prioritizes income generation and inflation protection while providing some growth potential and international diversification. It's appropriate for investors who are more concerned about preserving purchasing power than maximizing returns. Balanced allocation, 40% QQQ, 30% VNQ, 30% VTIX. This allocation provides equal emphasis on growth potential, income generation, and international diversification. It's appropriate for investors who want to balance multiple investment objectives without taking extreme positions in any single direction. Growth allocation, 50% QQQ, 30% VTX, 20% VNQ. This allocation emphasizes technology growth and international opportunities while maintaining some inflation protection. It's appropriate for investors who are more concerned about missing growth opportunities than preserving capital during market volatility. The key insight is that any of these allocations will likely outperform cash over the relevant time periods, while providing protection against most economic scenarios that could unfold over the next few years. Don't spend too much time trying to optimize between them. Just pick the one that matches your comfort level and implement it consistently. Risk management for this strategy involves several important considerations beyond just asset allocation. Position sizing is crucial because even the best investment strategy can fail if you invest more money than you can afford to lose, or if you're forced to sell during temporary market declines due to personal financial pressures. Never invest money you'll need within the next 2 years in these ETFs because market volatility could cause significant short-term losses, even if the long-term strategy is successful. Keep adequate cash reserves for emergencies and known expenses while deploying excess capital into the 3 ETF strategy. Rebalancing is another important risk management tool that most investors ignore until it's too late. Set specific dates, perhaps quarterly or semi-annually, when you review your allocations and bring them back to your target percentages. This forces you to take profits from outperforming assets and add to underperforming assets systematically. The rebalancing discipline prevents your portfolio from becoming too concentrated in any single asset class due to differential performance while ensuring you capture profits from successful positions. It also provides a systematic framework for making adjustments without relying on emotional decision-making during volatile periods. Tax optimization becomes important as your positions grow and generate dividends and capital gains. Consider holding these ETFs in tax-advantaged accounts like IRAs or 401ks if you have available contribution room. If you must hold them in taxable accounts, be mindful of timing when you rebalance to minimize unnecessary tax consequences. But don't let tax considerations override sound investment strategy. It's better to pay taxes on profitable investments than to avoid taxes by holding losing investments or keeping money in cash that's losing purchasing power. Tax efficiency is important, but it's secondary to achieving your investment objectives. The timeline for this strategy extends beyond just 2026 because the economic conditions we're facing aren't temporary disruptions that will resolve quickly. Deglobalization, demographic changes, infrastructure rebuilding, technological transformation, these are multi-year trends that will continue regardless of short-term market movements or political changes. This means you should be prepared to maintain these positions for 3 to 5 years minimum, with adjustments based on changing conditions rather than frequent trading based on market predictions. The longer time horizon allows you to ride out temporary volatility while capturing the full benefits of the economic trends you're investing in. However, you also need exit strategies for scenarios where the fundamental assumptions underlying this strategy prove incorrect. If inflation disappears and deflation becomes the primary concern, real estate exposure might become less attractive. If technology adoption slows dramatically, QQQ might underperform. If the US dollar strengthens significantly, international exposure might lag. Set specific criteria that would trigger strategy modifications, such as sustained deflation for 6 months, technology sector underperformance for 2 consecutive years, or dramatic improvement in US fiscal positions relative to international alternatives. Having predetermined exit criteria prevents emotional decision-making during stressful periods. The most important psychological preparation for implementing this strategy successfully is accepting that volatility and temporary losses are normal parts of the investment process rather than signs that the strategy is failing. The three ETFs will fluctuate in value, sometimes dramatically, but that volatility is the price you pay for higher expected returns. Market crashes and economic uncertainty create anxiety that causes many investors to abandon sound strategies at exactly the wrong times. Having predetermined allocation targets, systematic implementation plans, and clear long-term objectives helps you maintain discipline when markets become emotional and unpredictable. Here's what you need to do immediately to start implementing this strategy. First, calculate how much money you can afford to deploy over the next 4 to 6 months while maintaining adequate cash reserves for emergencies and known expenses. Second, open investment accounts with low-cost brokers that offer commission-free ETF trading. Vanguard, Fidelity, and Schwab all provide excellent platforms for implementing ETF strategies without excessive fees that would drag down your returns. Third, set up automatic monthly investments that will build your positions systematically regardless of market conditions or your emotional state on any particular day. Automation removes the temptation to time markets or second-guess your strategy during implementation. If this strategy makes sense for your financial situation and risk tolerance, don't wait for perfect market conditions or more economic clarity before taking action. Every day you wait while holding cash, you're losing purchasing power to inflation and missing potential investment returns that compound over time. Subscribe to this channel for updates on how these positions are performing and adjustments I'm making based on changing market conditions. Share this video with anyone who's struggling with what to do with their cash during these uncertain times. Leave a comment below and tell me which allocation strategy you're planning to use and what percentage of your cash you're ready to deploy into these three ETFs. The community of investors who understand these strategies needs to support each other through the volatile period ahead. Remember, the goal isn't perfection or maximum returns. The goal is protecting and growing wealth during one of the most challenging economic periods in modern history. These three ETFs provide a simple, diversified approach that should achieve that objective better than holding cash and hoping for the best.